Hello there. We're about to break down a really important and often misunderstood part of UK property tax. This entire guide has been put together by the experts over at My Tax Accountant, and it's designed to make sure you have all the facts. Okay, let's cut right to the chase. I've got one simple question for you. Does your company, or maybe a partnership you're involved in, own a residential property in the UK that's worth more than £500,000? If you answered yes, or even if you're just not sure, then you absolutely have to get your head around something called ATD. That's the annual tax on enveloped dwellings. And trust me, this isn't one of those things you can just put off, because the penalties for getting this wrong can be pretty nasty. Now, to make sure you don't get caught out, the team of experts at My Tax Accountant has developed this guide to walk you through everything step by step. We're going to cover what ATED is, who it hits, and most importantly, how to make sure you stay on the right side of HMRC. Right, let's get into it. So, here's our game plan. First up, we'll cover the absolute basics, what ATED actually is, and who has to worry about it. Then we'll get into the numbers, how the charges worked out for the 2025/26 tax year. After that, we'll talk about the really critical stuff, filing returns and hitting those deadlines. And then, and this is the part you'll definitely want to stick around for, we'll look at the reliefs that could save you thousands. Finally, we'll wrap up with how to get some expert help. So, first things first, what on earth is this tax? To really understand how it works, it helps to know why it was brought in the first place. Okay, so ATD is an annual tax. It's aimed squarely at UK residential properties worth over £500,000, but only when they're owned by what HMRC calls a non-natural person. Basically, the property is held inside a corporate envelope. For a long time, this was a smart way to hold property to avoid certain taxes. For example, instead of selling a house and having the buyer pay a ton of stamp duty, you just sell the company that owned the house. The tax on that was much lower. So back in 2013, the government brought in ATT to make that whole strategy a lot less appealing. So, what exactly is a non-natural person? Well, we're not talking about you or me as individuals. This is all about corporate structures. The main ones are right here. Companies, whether they're based in the UK or overseas, partnerships that have a company as a partner, and things like collective investment schemes. If your property is held in one of these ways, ATD should be flashing on your dashboard. And what about the property itself? Well, for ATED, a dwelling is pretty much any building that is used or even just could be used as a place to live. That includes the main building plus its gardens and grounds. But, and this is important, properties that are genuine businesses are usually excluded. It makes sense, right? The tax isn't trying to punish a company running a hotel or a block of student flats. So yeah, hotels, student halls, care homes, they're all out. All right, let's talk money. This next bit is all about the numbers. How you value your property, which, by the way, is where a lot of people get confused, and what the actual charges are for the 2025 to 2026 tax year. This here is the magic number, £500,000. The whole ATED system only kicks in for a single property valued above this amount. If your company's property is worth less than this, you can relax. But if it's over this line, you really need to listen up. Okay, this is so important and it trips up so many people. The value of your property for ATED is not what it's worth on the market today. It's based on a fixed 5-year cycle. For the entire period from April 2023 all the way through to March 2028, and that includes the 2025/26 year we're focused on, the date that matters is April 1st, 2022. You need to know what your property was worth back on that specific date. Simple as that. The next time you have to revalue isn't until 2027. And here's a quick pro tip just to make that super clear. What if your company bought the property after that April 2022 valuation date? Well, in that case, the rule is easy. You just use the value of the property on the exact day your company bought it. It keeps things nice and straightforward. Okay, let's look at the charges themselves for the years starting April 1st, 2025. It's a banding system. The more the property is worth, the more you pay. It's that simple. So let's imagine a small business, say City Homes Ltd, that owns a flat in London. Let's say it was valued at £800,000 back in April 2022. Looking at the table, they're in that first band, so their annual ATED charge is £4,450. But just look at how fast that jumps. Imagine another company, maybe an overseas one called GNEV Holdings, owns a fancy house in London worth £5.5 million. Suddenly, their annual bill skyrockets to £72,700. It shows you the cost of just letting a property sit there is incredibly high. So you know if you're in the ATED net and you've seen what it could cost.
But that's not all, and here's where things often go wrong for people. The next bit is all about compliance. What do you actually have to do, and by when?
The process each year breaks down into these 4 key steps. 1, get the right valuation for your property using that April 2022 date. 2, calculate the charge using the numbers we just saw. 3, you have to complete and submit an ATED return online for every single property that's affected. And 4, you pay the tax bill. It sounds simple, I know, but the deadlines are unbelievably strict. Okay, timing is everything. The one date you need to have circled in your calendar is the 30th of April. Your return and payment for the tax year ahead are due by April 30th at the start of the year. But if your company snaps up a property midway through the year, you've only got 30 days to sort it out. And for a brand new build, it's 90 days. These shorter deadlines can catch anyone out, no matter how organized you are.
So this leads us to a really important question. What actually happens if you miss one of these deadlines? Because this is where a tiny oversight can turn into a very big and very expensive problem.
Let me be blunt. HMRC's penalty system for ATED is completely automatic. There's no wiggle room. The moment you're 1 day late with filing, you get an instant £100 penalty. If that goes on for 3 months, they start adding daily penalties of £10 a day. That's another £900 right there. After 6 months, there are even more penalties. That initial £100 fine can easily spiral to over £1,000. And on top of all that, they charge interest on late payments, and they can penalize you for an inaccurate return too. The costs add up scarily fast.
Right, after all that doom and gloom about charges and penalties, let's get to the good news. And stay with me, because this next part might genuinely surprise you. Paying a massive ATED charge isn't always a given, even if your company owns a super high-value property. Yup, you saw that correctly. It is absolutely possible for your company to own a property worth millions and have an annual ATED charge of 0, a big fat nothing. So how's that possible? The secret is claiming a qualifying relief. These are available if the property is actually being used for a real business purpose. Here are the most common reliefs you can get. The idea behind them is really simple. If the property is earning its keep as part of a real business and not just being used by the owner for personal reasons, you can probably claim relief. So this covers properties rented out commercially, houses held by developers as trading stock, historic homes open to the public, or even accommodation for employees. The key thing is that ATED is really designed to hit passively held properties, not active businesses. Okay, now I need you to listen very, very carefully to this. This is the single most important rule of ATED, and it is the biggest and most expensive mistake people make. Even if your property qualifies for 100% relief and you owe 0 tax, you still have to file a return by the deadline to officially claim it. If you just do nothing because you think you don't owe anything, HMRC won't know that, and they will automatically hit you with those late filing penalties we just talked about. This just makes it crystal clear. There are 2 paths. If you owe tax, you file a full ATED return and you pay up. If you're claiming a full relief and owe nothing, you file a slightly simpler form called a relief declaration return. But here's the bottom line. Both are required. In both situations, you have to take action and file something with HMRC before that April 30th deadline. Whew, okay. Let's pull all of that together. We've talked about what ATED is, who it's for, the big costs involved, those tough deadlines, and the super important reliefs. Let's do a quick fire recap of the main points before we talk about where you can get some help with all this. If you only remember 5 things, make it these. 1, ATED is for companies with UK homes worth over $500,000. 2, the valuation date that matters right now is April 1st, 2022. 3, the big deadline is April 30th every year. 4, reliefs can wipe out your bill, but you absolutely must file a return to claim them. And 5, don't ignore this tax. The penalties are real, they're automatic, and they hurt. Now, of course, please remember that everything we've talked about here is for general guidance. ATED is a really tricky area of tax, so before you make any final decisions, it's so important that you speak to a professional tax expert, like the fantastic team at My Tax Accountant. And that's exactly where they come in. If you're feeling a bit lost with your AATD duties, or you need a hand with valuations, or making sure you're claiming the right reliefs, they are the people to call. You can get in touch on +44 02 08 570 8531, or just drop them an email at info@mytaxaccountant.co.uk. For even more detail, you can read their full article on their blog. And of course, make sure you subscribe to their YouTube channel for more great tax advice. Thanks so much for watching.